importance of it. We have, measured by cap accounting, more than any other company in the United States. We have more than any of those companies that are on the list of the largest companies in the country, but we've got it by a substantial margin. So we have an investment in what makes this country move and work. 15% of the interstate goods move on our railroad, and we're building transmission. And we started in 2006 or 7 planning how we would close coal plants. But you can't close coal plants until you get the electricity from where it's generated to the customer. And if you're going to generate it in Wyoming, and it's going to go to Las Vegas or someplace, and previously they had a coal plant near the place because that was the way it was done 50 years ago or 75 years ago, you better have the transmission. There's no sense having the wind blow in Wyoming and people turn on the lights in Las Vegas. So we went at the transmission plan question a lot earlier than people were talking about it. And we said $16 billion or whatever it was in the annual report that we underway, and we just added $2 billion since the annual report came out. And there's no utility in the country that's coming anywhere close to that. Tell them a little bit about it.
Sure, Warren. Thank you. And really, as Warren touched on, BHE and BNSF have the significant carbon footprints when you think of Berkshire. And Warren, you touched on the disclosure that we've provided in the past, going all the way back to 2007. I did pull those 2 investor presentations, one from 2007 and then our most recent one in 2021. So if we could pull up BHE one as a slide, I think it would just highlight, going all the way back to 2007, we've been doing investor presentations for what we call our fixed income investors. And we've done that through every year through 2021. We've provided very similar disclosures to our board on an annual basis and had discussions around Berkshire Hathaway's energy's plans to decarbonize. Now, it's interesting, if you go back to the 2007 fixed income conference, and we were having a conference at that point in time. We have third-party debt, capital debt that our utilities raise. It's a traditional capital structure used across our regulated entities to manage our total cost to the customer. So we have investors. We present to them as we're highlighting on an annual basis. And if you go back to that 2007 investor conference, it's interesting. In that presentation, we're highlighting climate change, that it's a fundamental risk, and we discussed what good policy would be. We discussed innovation, we discussed market transformation, and the importance of setting targets at that point in time, and we had recommendations for our industry. And then since then, each year we've presented really a plan and a strategy around how each of our businesses in BHE, but each of our regulated entities, how they're going to transform. And the whole transformation has been around decarbonization, managing that risk on behalf of our stakeholders in our many states, our customers that we serve, and ultimately managing that risk for Berkshire Hathaway's shareholders. Now, as you go through those presentations, there's a common theme, and Warren touched on it already. You have to build the foundation first. And that foundation is around building the high voltage, the transmission system. Warren touched on it in his annual report this year, and letter he highlighted that at Berkshire Hathaway Energy will be spending just in the West $18 billion on transmission. $5 billion of that's already been spent as we sit here today, and that $13 billion will be spent over the next 10 years. That's the foundation that then allows us to build incremental renewable resources and move it to our many states that we serve at Berkshire Hathaway Energy and well beyond that. I would highlight, while we've been building the transmission infrastructure in place, we have been building renewables. If you look at our investment through the end of 2020, we've invested $30 billion, or in excess of $30 billion, into renewables, and have really completely changed the way our businesses do business. i.e. our utility businesses. They've been decarbonizing and delivering a valued product to our stakeholders, to our customers. And I think the results are really amazing when you look at them, and I'll give you a couple of reference points. If you go back to 2015, when the U.S. was discussing, joining the Paris Agreement, very specific targets were set. Prior to those targets being set, Berkshire Hathaway Energy and 12 other companies, including the Apples of the world, Google, Walmart, committed to Paris, and that targets needed to be set. Berkshire Hathaway Energy was one of those companies in 2015.
Yeah, how many other utilities were there?
Right, Warren, there were no other energy companies that made any type of commitment at that point in time. I'm happy to report we made a variety of pledges. Well, one of them was at that point we'd invested $15 billion in renewables, and that we would commit $30 billion in total. Well, we far exceeded that total now. So there's been a clear commitment to decarbonizing our businesses. We have focused on very identifiable, quantifiable outcomes, and I think that's very important. If you look at the standards that were set with the original U.S. government's commitments associated with the Paris Agreement, the target was 26 to 28% reductions in carbon footprints going back to 2005, so that's the reduction period, through 2025, and they wanted the 26 to 28% reduction level. We committed to that at BHE, and I'm happy to report, Warren, we've briefed our board, we achieved that in 2020. So we met our pledge, and we met the commitment under the Paris Agreement. And then if you fast forward to the discussions that are occurring right now or have occurred around rejoining the Paris Agreement, the current administration has proposed that, again, using 2005 as a starting point, that the emission goals or reduction should be 50 to 52% by 2030. Again, I'm happy to brief to our shareholders and briefings we've provided to our board, but Berkshire Hathaway Energy will achieve that by 2030. Our reductions will hit the Paris Agreement target. Again, the reason we can do it is we've built the foundation through transmission, the substantial investment that Warren's highlighted, and then followed that up with very specific investments on the renewable side. I have one incremental slide that I hope sort of pulls it all together, and that's BHE2. Because as people discuss carbon, they often go to coal units, how many you own, how many of you close. And there's no question that can be an important metric, but it is a transition. And we have very much focused across the three utilities we own and the ones we've highlighted on the slide is to transition from our existing fleet to renewables using transmission. We have not become overly dependent on transitioning to gas. That's been a clear strategy. So over a period of time, our coal units will retire. I'm happy to report, or pleased to report to our shareholders that through 2020, we've closed 16 units to date. If you look at from 2021 through 2030, there'll be an incremental 16 units closed. And then if you go through to the end of 2049, our remaining 14 units will be closed. And at that point in time, all our coal units are closed. That slide is just an aggregation of all the activities each of our business units have been taking to help facilitate that transition and really transitioning to a decarbonizing those units. And I said decarbonizing our businesses on behalf of, first and foremost, our customers, the many stakeholders they represent in the various states. And then equally important, decarbonizing those businesses on behalf of our Berkshire Hathaway shareholders. The only other thing I would add, because it is the entity that has the second largest carbon footprint in Berkshire. And when you combine BNSF and BHE, you're talking the material set of emissions within Berkshire. BNSF has also been very active in managing their carbon profile. They've committed to have science-based targets established for 2030. So again, those targets will again be consistent with the Paris Agreement. We've seen what the other participants, or some of them in the class in the industry, that have committed to. And our commitment will be very similar. It'll be consistent with the Paris Agreement, but it'll be a 30% reduction in BNSF's footprint by 2030. So again, if you look at our, and that's been publicly disclosed, that's on the BNSF website. Everything I've discussed regarding BHE is on their website, filed in 8Ks, completely accessible by our many shareholders. So when I look at it from the perspective of our Berkshire shareholders, I really believe this risk is being well managed, and we're positioning ourselves for the long term. Thanks, Warren.
Yeah, incidentally, I mean, the president the other night talked about $100 billion for infrastructure. We'd love to spend $100 billion, but he was talking about, transmission is really the problem. I mean, a big problem, because you got to get from where the sun is shining and where the wind is blowing, essentially to concentrations of population, and it'll be whether you cross state lines and you go through people's backyards. It's whether the federal government has a better luck in just saying this is the way it's going to be done and ramming it down the throats of where they go and getting it done. I mean, they may have that power, and they'll be able to do it faster than we are. On the other hand, we'd love to do it. We'll spend $100 billion, but the speed at which we can do it is. We bought Pacific Corp in 2006, and we had a bunch of customers out in the far west, and they had coal plants serving them. And to change that, you've got to be able to go to where wind blows and deliver it. So but it is interesting that we have published this information. We've spent far more than any utility than in terms of renewables and transmission in the United States. And we started with a nothing, little operation. But the people who bought the stock with their own money, the individuals, they seem to understand it, and they read the reports. And we get calls, and they say, well, we want to come out and talk to you about it. Well, we're not talking to them and ignoring the million people that have been with us over time and bought it with their own money. We will not give special treatment to either to analysts or to institutions over the individuals that basically trust us with their savings for their lifetime.
This question is for Warren and Ajit. It comes from Fernando Lewis, a longtime Berkshire shareholder from Panama, who says, as a shareholder that intends to remain so for many decades, my biggest concern is around possible losses arising from higher than expected insurance losses. We've seen this in other great companies where underwriting mistakes end up crippling businesses previously considered exemplar. While I understand that Berkshire's culture is unique and the insurance division is full of talented individuals, this is a risk that concerns me. Many of us shareholders feel comfortable now, given the privilege of having Mr. Buffett, Mr. Munger, and Mr. Jain looking at these deals. However, there will be a day when this is no longer the case. Is it reasonable to think that over the long term, Berkshire should focus on plain vanilla short-tail insurance businesses like Geico and reduce the size of some long-tail risk? I want to clarify that I have the most respect and gratitude for all of Berkshire employees that have built the best insurance group in the world. I'm confident we have this talent to remain leaders in this field for decades to come. This is focused on the inherent opaqueness and risk of some insurance lines.
Ajit, do you want to lead off?
I mean, clearly contract certainty is an issue for us in the insurance industry. It is an issue that cuts across not only the long-tail lines that you mentioned, but even short-tail property-focused lines. The most recent example is business interruption, which is an integral part of any property insurance policy that is bought and sold by corporations. It is a risk every time we issue a contract that either because of sloppiness in terms of how that contract is written or because of the regulatory environment we all have to live in, that the words in the contract may be tortured and normally when they are tortured, they end up going against the insurance industry, not in their favor. So it is a risk. It's an unknown risk in terms of how bad it can be. I hope we price for it. When we price for the product, we throw in something for the unknown unknowns, if you will. And we try and aggregate our exposures by major risk categories. Hopefully that will give us some comfort in terms of having some boundaries on what the exposure really can be. But there's no question the regulators play a very important role in terms of the economics of the business, especially in the U.S. where there are 50 state regulators who we have to deal with in terms of pricing, in terms of contracts, in terms of...
Most of the surprises in insurance, practically all of them, are unpleasant. I mean, you get the premium up front, that's pleasant. And then from there on, you get some very imaginative losses that come through, and you get some that you've taken on. We are willing to lose in terms of sort of the outside limit. We think, well, we're willing to lose $10 billion in a single event. And we want to get paid very appropriately for that. But we've got the resources to do it, and but we don't want to lose $10 billion in something where we only thought we could lose $50 million or something like that. And the current situation, for example, with the Boy Scouts of America, I think there were 1,100 claims or something like that have been filed, and now there's 17,000 just in.
No, they're close to 100,000 now.
Oh, yeah, and
up by 50 times.
And these go back to 1950 or 1960, and you've got people advertising for claims, and so all of a sudden you get a lot of claims. I'm sure a lot of the claims are valid. I'm sure a lot of them are invalid. And how in the world do you pick out the difference?
Yeah, and it goes back to the issue that you just raised. The reason why this number of claims have skyrocketed from less than 2,000 to close to 100,000 is because the statute of limitations had expired. But in several states, if not in most states, they have unilaterally extended the deadline by when you can make claims and expanded it by a few years, as a result of which a lot of more claims have appeared, funded by plaintiff lawyers who are now very well funded. And that results in claims just skyrocketing.
Yeah, we get a lot of unpleasant surprises in insurance, but we've got a very. I'm very biased on this, but I think we've got the best insurance operation in the world, and Ajita's the guy that created it, and the people at Geico, we bought that, and they did wonderful things over time to contribute their part of it too, and other people have, but Ajita's a symphony conductor of it.
This question comes from Henry Zhu, and he says, it looks like Charlie and Warren have some different opinions recently, like Costco and Wells Fargo. Where's that taking Berkshire?
Charlie?
Well, we're not all that different. And Costco is a company I very much admire, and I've enjoyed my long association with that company. But I love Berkshire too. So, and luckily there's no conflict. And Warren and I don't have to agree on every damn little thing we do. We've gotten along pretty well.
We got better than pretty. We have never had an argument.
Yeah.
In 62 years, and it's not that we agree on everything. We literally, in 62 years, we've never gotten mad at each other. It just doesn't happen.
This question's from Jason Plonner, and he says, Mr. Jain and Mr. Abel, this question's for you. One of the successful features of Berkshire is the strong bond between Mr. Buffett and Mr. Munger, who managed the company better because they had each other. As you two are clear leaders of the next generation at Berkshire Hathaway, can you please tell us about how you interact with each other? or some of the other incredibly competent Berkshire managers you seek for advice?
Who's that directed at?
At Greg and Ajit.
Okay.
Well, there's no question that the relationship Warren has with Charlie is unique, and it's not going to be duplicated, certainly not by me and Greg. No, I can't think of very many other pairs that can duplicate it. Nevertheless, both Greg and I, at least certainly from my perspective, and I'm sure Greg will speak for himself, we've known each other for a very long time. I certainly have a lot of respect, both at a professional level and a personal level, in terms of what Greg's abilities are. We do not interact with each other as often as Warren and Charlie do, but every quarter we will talk to each other about our respective businesses and update each other on our respective businesses. And then during the course of the quarter, while we may not have any formal sort of meetings, if you will, but every time a question comes up which is related to insurance, Greg will pick up the phone and call me. By the same token, if there's any question that comes up relating to any of the non-insurance operations that Greg is in charge of, like we had recently where a client of mine was trying to find a buyer, and I picked up the phone and talked to Greg, and we talked about, how best to proceed. So there's that happens during the course of the quarter. Every quarter we exchange notes, and we have a perfectly well-functioning relationship between the two of us, and I hope it remains that way. Greg?
Yes. Well, as you well said, and as he touched on, Warren and Charlie have an exceptional relationship, but I'm very proud of the relationship Ajit and I've had. And as Ajit touched on, it's developed over many years. We've had the opportunity, or I've had the opportunity to see how Ajit's run the insurance business. And as Warren and Charlie highlights, there's no one better at it. So I've had the opportunity to observe that. And then equally over the years, that relationship has just built and become greater and greater. And as Ajit touched on, couldn't have more personal respect for Ajit, both personally and professionally. And even though the interaction may be different than, say, how Warren and Charlie do it, as Ajit touched on, there is a regular dialogue, both around opportunities within our two businesses and units, both if we see something unusual that the other individuals should hear, we make sure we're always following up with each other. But it goes beyond that. Ajit has a great understanding of the Berkshire culture. I strongly believe I do too. And anytime we see anything unusual in one of our businesses, it's Ajit who I'm going to call and say, are you comfortable that we're taking this approach? Is it going to be consistent with how you think about it in insurance? So it goes beyond just discussing the businesses, but that maintaining the exceptional culture we have at Berkshire and building upon that. So very fortunate to have Ajit as a colleague and immensely enjoy working with him every day. Thank you.
This question comes from Glenn Greenberg. He says, it's on the profitability of Geico and BNSF. He said, why do these companies operate at meaningfully lower profit margins than their main competitors, Progressive and Union Pacific? Can we expect current managements to at least achieve parity?
Was it Geico and?
BNSF.
Oh, actually, if you look at the first quarter figures, you'll see that the Berkshire Hathaway Union Pacific comparison has got quite better. Katie Farmer's doing an incredible job at BNSF, and been an interesting question whether 5 years from now or 10 years from now BNSF or Union Pacific has the higher earnings. We've had higher earnings in the past. Union Pacific passed the first quarter. You can look at and they think they've got a slightly better franchise. We think we've got a slightly better franchise. We know we're larger than the Union Pacific. I mean, we will do more business than they do, and we should make a little more money than they do, but we haven't in the last few years. But it's quite a railroad. I feel very good about that. I should go back to the previous question. People talk about the aging management at Berkshire, and I always assume they're talking about Charlie when they say that. But I would like to point out that in 3 more years, Charlie will be aging at 1% a year. And he is no one is aging less than Charlie. If you could take some of these new companies with 25-year-olds, they're aging at 4% a year. So we will have the slowest aging managed percentage-wise by far that any corporate, any American company has.
Did you want to talk about Geico versus Progressive too? Because I got a lot of questions on that.
Progressive has had the best operation in recent years in terms of matching rate to risk, and I mean that's what insurance is all about, among other things. But I mean, you have to have the right rate. If you think that 90-year-olds and 20-year-olds have an equal chance of dying, I mean, you're going to be out of business very quickly in the life insurance business, and you will get all the 90-year-old risks, and the other guy will get the 20-year-old risks. And the same thing applies in auto insurance. I mean, there is a huge difference between 16-year-old males and how they drive, and 40-year-old married, employed people. So the companies that do the best job of actually having the appropriate rate for every one of their policyholders is going to do very well. And Progressive has done a very good job on that. And we're doing a much better job on that already. But Todd Plums has gone there, and it's a very interesting business. Both Progressive and Geico were started in the 30s. I believe I'm right about Progressive on that, and we were started in 36. We have had the better product for a long, long time, I mean, in terms of cost. And here we are, 85 years later in our case, and we have about 13% or so of the market, whatever it may be, and Progressive has just a slight bit less. So the two of us have 25% of the market, roughly, in this huge market after 80-some years of having a better product. So it's a very slow-changing competitive situation, but Progressive has done a very, very good job recently. We've done a very, very good job over the years, and we're doing a good job now, but we have made some very significant improvements. And if you looked at don't want to look at the quarters too much, but our profitability in the first quarter was good. But we gave back more money under our give-back arrangement when the virus broke out. We gave $2.8 billion on our give-back program that was larger than any company as well. It was the largest, I think, in the country. And Geico and Progressive are both going to do very well in the future. And actually, the Union Pacific and BNSF are going to do well in the future. It's just, in both cases, we want to do a little bit better than the other guy.
Can I just add a little bit? Yeah. There's no question Progressive is a machine. They're very good at what they do, whether it's underwriting, which Warren talked about in terms of matching rate to risk, whether it's handling claims. Having said that, I think Geico is catching up with Progressive. More than about a year ago, Progressive had margins that were almost twice as much as Geico's, and growth rates that were almost twice as much as Geico's. If you look at the results as of now, Progressive is still crushing it in terms of growth relative to Geico. But Geico has certainly caught up with Progressive in terms of margins, and hopefully that gap will be non-existent in the future. The second point I want to make on the issue of matching rate to risk, Geico had clearly missed the bus and were late in terms of appreciating the value of telematics. They have woken up to the fact that telematics plays a big role in matching rate to risk. They have a number of initiatives, and hopefully they will see the light of day before not too long, and that will allow them to catch up with their competitors in terms of the issue of matching rate to risk.
I will predict that 5 years from now, State Farm is still the largest auto insurer, but I will predict that 5 years from now, it's very likely that the top two will be Geico and Progressive, and in which order we'll see. But both companies are going to do very well, in my opinion. Geico's done well, extremely well, but Progressive was better at setting the right rate, and we're catching up, I think, fairly fast.
Yeah, Progressive has certainly done better, but when it comes to branding, Geico is, I think, miles ahead of Progressive, and in terms of managing expenses as well, I think Geico does a much better job than anyone else in the industry.
This question comes from Vittorio Aguici from Switzerland, who writes in, why in the recent past did Berkshire sell some of the common stocks owned on Apple? If the company is considered Berkshire's fourth jewel, why didn't Berkshire buy more of Apple stocks in 2020? This seems to be counterintuitive.
Well, we have 5.3% or something like that now. It's going up in the first quarter because we bought in our shares, which helps our own shareholders expand their interest in Apple indirectly without laying out a penny. And then Apple's repurchased its shares and just announced another repurchase program. So let's say we look at Apple as a business that we own 5.3%. Now, we've got it's a marketable security, so it shows up as way greater than any other marketable security we have. But, of course, if you look at our railroad, as we mentioned, well, Union Pacific is selling for about $150 billion in the market, and we own one that's a little larger than the Union Pacific and making a little less money, but not much less. So it's an extraordinarily Apple. It's got a fantastic manager. Tim Cook was underappreciated for a while. He's one of the best managers in the world, and I've seen a lot of managers. And he's got a product that people absolutely love, and there's an installed base of people, and they get satisfaction rates of 99%. And I get the figures from the Furniture Mart as to what's being sold, and if people come in and they want an Android phone, they want an Android phone. If they want Apple, they want an Apple phone. You can't sell them the other one. I mean, the brand and the product is it's an incredible product. It's a huge bargain to people. I mean, the part it plays in their lives is huge. I use it as a phone, but I'm probably the only guy in the country. You know, maybe some descendant of Alexander Graham Bell's doing the same thing, but it is indispensable to people. And, you know, it costs, you know, car costs $35,000. And I'm sure with some people, if you asked them whether they wanted to had to give up their Apple or give up their car, you know, and really make the choice for the next 5 years, you know, who knows what they do. But and we you know, we got a chance to buy it, and I sold some stock last year, although our shareholders still had their percentage interest go up because we repurchased shares. But that was probably a mistake. In fact, Charlie, in his usual low-key way, let me know that you thought it was a mistake too, didn't you, Charlie?
Yes.
Yeah. Yeah. I could only do so many things that I could get away with, Charlie, and I kind of used them up between Costco and Apple. And incidentally, he probably, he very likely was right in both circumstances. It's an extraordinary business. But I do want to emphasize that in his own way, it's a different way, but Tim Cook is, we see a lot of managers of a lot of businesses, and you're looking at two great ones on both ends here. He's handled that business so well. He couldn't do what Steve Jobs obviously could do in terms of creation, but but Steve Jobs couldn't really, I don't think, do what Tim Cook has done in many respects.
Well, I also think it's clear that that list you showed of the leading American companies, it's been very important for America that we've done so well in this new tech field. And I personally would not like to see our present giants brought down to some low level by some anti-competitive reasonings. I don't think they're doing a lot of harm anti-competitively. I think they're a credit to the Americans, credit to our civilization.
And they're huge.
And they're huge, and that's good for us.
Well, let me ask a follow-up question on that then. This comes from Jack Sang, who says, what's your mindset when you see so many of these high flyers, not the GME or meme stocks, but more like the big tech growth stocks, gaining 50%, 100%, 200%, et cetera, in a matter of a year or less? I know you eventually bought Apple in 2016 because of the quality of their businesses and their management. How do you assess if these high flyers are worthy of your investment, given this crazy high valuations that muddy the waters?
Well, we don't think they're crazy. But we don't, at least Charlie, I feel that I understand Apple and its future with consumers around the world better than I understand some of the others. But I don't regard prices, and that gets back. It gets back to something fundamental in investments. I mean, interest rates, basically are to the value of assets what gravity is to matter. Essentially. And on the way out here, I tore out a little clipping from the Wall Street Journal yesterday. Probably the only one that read it. It's so small, I'm having trouble finding it. But anyway. Yes, on Thursday, the U.S. Treasury sold some 4-week notes, Treasury bills, and the price was if you looked at your Wall Street Journal down a little corner next to the last page in my paper, in the very bottom corner, here it is. The results of the Treasury auction, a little tiny thing. They sold they had applications on the 4-week Treasury bill for $100 and some billion. They accepted bids for $43 billion worth. And it says average price 100.00000. 6 zeros. And essentially, people were giving $40-some billion to the Treasury, and they offered to give $130 billion or something, whatever the amount tendered. And the Treasury received the money at zero. And Janet Yellen has talked a couple of times about the reduced carrying cost of the debt. I think in the last fiscal quarter, the U.S. Treasury, the U.S. government, which owes a few trillion dollars, I should say, a few trillion dollars more than a year ago, their interest expense was down 8%. So you've had this incredible reduction in the so-called super risk-free group, the short-term Treasury bill, and that is the yardstick against which other values are measured. I mean, if I could reduce gravity's pull by about 80%, I mean, I'd be in the Tokyo Olympics jumping. And essentially, if interest rates were 10%, valuations are much. So you've had this incredible change in the valuation of everything that produces money, because the risk-free rate produces really short enough. Right now, nothing. It's very interesting. I brought this book along because for 25 or more years, Paul Samuelson's book was the definitive book on economics. It was taught in every school. And Paul was the first Nobel Prize winner. It's sort of a cousin to the Nobel Prize. They started giving it in economics, I think in the late 60s. He was the first winner from the United States, Paul Samuelson. Amazingly enough, the second winner was Ken Arrow, and both of them are the uncles of Larry Summers. Larry Summers had the first two winners as uncles. But Paul, he was a wonderful guy. He was a wonderful writer, the definitive writer. And so I got out the 73 economics book. And bear in mind, probably economics kind of started as kind of an interesting science and respect. But with Adam Smith, we'll say, he wrote The Wealth of Nations in 1776, and he'd written some books earlier, but you sort of date it from kind of when our country started. And then you had all these famous economists subsequently. And Paul became the most famous of his time. So I looked up in the back under interest rates. I looked for negative interest rates. There's nothing there. So I finally found zero interest rates, and Paul Samuelson, brilliant man, after a couple of hundred years we've had of kind of studying economics, basically, he said that he said you can conceivably, technically, you can conceive perhaps of negative interest rates, but it can't ever really happen. And that was, in the 1970s. This wasn't back in the dark ages, and this was and no economist wrote up and said, this is a terrible line to have in a book or anything. And here we are in this world where we had zero interest rates last week or this week on a four-week note, and Berkshire Hathaway, which has more than this, but let's say we had $100 billion in Treasury bills. We have more than that. Before the pandemic, we were getting about $1.5 billion from that a year. At present rates, if it's 2 basis points, we'd get $20 million. Imagine your wages going from $15 an hour to 20 cents an hour or something. It's been a sea change, and it was designed to be that. I mean, it was that's why the Fed moved the way they did. They wanted to give a massive push, just like Mario Draghi did in Europe in whenever it was 2012, when he says whatever it takes, and they went to negative rates. And the Fed has said it doesn't want to go to negative rates, and I think the Treasury actually has got some small bar. But if present rates were destined to be appropriate, if the 10 years should really be at the price it is, those companies that the fellow mentioned in his question, they're bargain. I mean, they have the ability to deliver cash at a rate that's, if you discount it back, and you're discounting at present interest rates, stocks are very, very cheap. Now the question is what interest rates do over time. But there's a view of what interest rates will be based in the yield curve out to 30 years and so on. It's a fascinating time. We've never really seen what shoveling money in on the basis that we're doing it on a fiscal basis while following a monetary policy of something close to zero interest rates, and it is enormously pleasant. But in economics, there's one thing always to remember: you can never do one thing. You always have to say, and then what? And we are sending out huge sums. I mean, the President said it on Wednesday, 85% of the people were going to get a $1,400 check, or 85%. And a couple of years ago, we were saying 40% of the people never could come up with $400 of cash. So we've got 85% of the people getting those sums. And so far, we've had no unpleasant consequences from it. I mean, people feel better. The people who get the money feel better. And people who are lending money don't feel very good. But it causes stocks to go up. It causes business to flourish. It causes an electorate to be happy. And we'll see if it causes anything else. And if it doesn't cause anything else, you can count on it continuing in a very big way. But there are consequences to everything in economics. But that is why the Googles and the Apples, when we don't own Google, we don't own Microsoft, but they are incredible companies in terms of what they earn on capital. They don't require a lot of capital, and they gush out more money. And if you're trying to find bonds that gush out more money from the federal government, we got $100 billion that's gushing out, like $30 or $40 million a year, or whatever it may be, depending on the short-term rates. So that puts the pressure on, which is exactly, of course, what the monetary authorities want done. I mean, they're pushing the economy and they're doing it in Europe, even more extreme. And they're pushing, and we're aiding it with fiscal policy, and people feel good. And people have become numb to numbers. You know, trillions don't mean anything to anybody. You know, and $1,400 does mean something to them. So we'll see where it all leads. But Charlie and I consider it the most interesting movie by far we've ever seen in terms of economics, don't we, Charlie?
Yes, and the professional economists, of course, have been very surprised by what's happened. It reminds me of what Churchill said about Clement Attlee. He said he was a very modest man and had a great deal to be modest about. And that's exactly what's happened with the professional economists. You know, they were so confident about everything. And it turns out the world is more complicated than they thought.
As a follow-up to that, Pat King, what's your opinion about the economic theory MMT, especially the United States, because it's the reserve currency for the world?
Well, I think the modern monetary theorists are more confident than they ought to be, too. I don't think any of us know what's going to happen to this stuff. I do think there's a good chance that this extreme conduct is more feasible than everybody thought. But I do know if you keep just doing it without any limit, it will end in disaster.
On a related question, L. Candle wrote in on this too and said, if you can borrow money at a guaranteed low or even zero interest rate, is it still worthy of borrowing money for not that guaranteed cost from the insurance operation?
It reduces the value of float by a substantial amount. And we have a flexibility with our float that virtually no one has. And I've written about this in the annual letter. But the value of float has gone down dramatically because everything is off of interest rates. And when you get to negative interest rates, if a country can borrow at negative interest rates, you get into something that's kind of akin to the St. Petersburg paradox. And those of you who want to go to search, you can find some interesting things on it. But it becomes infinite. It's a crazy consequence of a bunch of abstract mathematics where you get there. But you lose gravity entirely. And you know, if you tell me that I'm going to have to lend money to the government at minus 2% a year, and I'm talking nominal figures, not you know, you're just telling me how I'll go broke over time. if I do that, so it pushes you to do other things. And of course, we've seen it. Well, we saw the rest of the world do it in even more extreme fashion, but nobody, Paul Samuelson, brilliant man, nobody thought you could do this, and we don't really know what the consequences are. But we know there are consequences, obviously.
This question comes from Sam Butler, who says he's been a shareholder for many years and asks, what impact does the rise of so many new SPACs have on Berkshire's ability to find and close new acquisitions?
Well, it's a killer. The SPACs generally have to spend their money in 2 years, as I understand it. So they have to buy a business in 2 years. If you put a gun to my head and said you got to buy a big business in 2 years, you know, I'd buy one, but it wouldn't be much of one. You know, we look and now there are, I don't know how many, whether it's hundreds, and there's always been the pressure from private equity funds. I mean, if you're running money for somebody else and you're getting paid a fee and you get the upside and you don't have the downside, you're going to buy something. And I could tell you, but I had a call from a very famous figure many years ago that was involved in it and wanted to learn about reinsurance. And I said, well, I don't really think it's a very good business. And he said, yeah. He says, if I don't spend this money in 6 months, I've got to give it back to the investors. So it's a different equation that you have if you're working with other people's money where you get the upside and you have to give it back to them if you don't do something. And frankly, we're not competitive with that. Yeah, and that won't go on forever. But it's where the money is now, and Wall Street goes where the money is, and it does anything, you know, basically that works. And SPACs have been working for a while, and you stick a famous name on it, you can you can sell almost anything, and it's an exaggerated version of what we've seen in kind of gambling done type market. In fact, I did have a quote from Keynes that we might put up on the. Let's see if I've got. Yeah, this is probably one of the most famous quotes in history, because it really sums up the problem of the fact we've got the greatest markets the world could ever imagine. I mean, imagine being able to own parts of the biggest businesses in the world and putting billions of dollars in them and take it out of, 2 days later. I mean, compared to farms or apartment houses or office buildings where it takes months to close a deal, I mean, the markets offer a chance to participate and invest in earning assets on a basis that's very, very low cost, and instantaneous, huge, all kinds of good things. But it makes its real money if they can get the gamblers to come in, because they provide more action and they're willing to pay sillier fees and all kinds of things. So you have this incredible, huge asset to humanity, but it really makes its money when people are doing stupid things. I mean, that's where the money really is. And Keynes wrote this in 1936. It says 1939 on the slide, but he wrote it in 1936 in the General Theory, that speculators may do no harm as bubbles on a steady stream of enterprise. But the position is serious when enterprise becomes the bubble on a whirlpool of speculation. When the capital development of a country becomes a byproduct of the activities of a casino, the job is likely to be ill done. Well, the stock market, we've had a lot of people into the casino in the last year. You have millions and millions of people have set up accounts where they day trade, where they're selling puts and calls, where they. I would say that you had the greatest increase in the number of gamblers, essentially. And there's nothing wrong with gambling, and they got better odds than they've got if they play the state lottery. But they've had cash in their pocket, they've had action, and they actually have a lot of good results. And if they just bought stocks, they do fine and held them. But the gambling impulse is very strong in people worldwide, and occasionally it gets an enormous shove, and conditions lead to this place where more people are entering the casino than are leaving every day, and it creates its own reality for a while. And nobody tells you when the clock's going to strike 12 and it all turns to pumpkins and mice. But when the competition is playing with other people's money, or and if they're playing foolishly with their own money, but the big stuff is done with other people's money, they're going to beat us. I mean, we're not. That's a different game, and they've got a lot of money, so we're not going to have much luck on acquisitions while this sort of a period continues. But it's happened before. This is about as extreme as we've seen it, isn't it, Charlie? Or?
Yes, of course. I call it fee-driven buying. In other words, they're not buying because it's a good investment. They're buying it because the advisor gets a fee. And, of course, the more of that you get, the sillier your civilization is getting. And to some extent, it's a moral failing, too. Because the easy money made by things like SPACs and total return derivatives and so on, you push that to excess, it causes horrible problems for the civilization. And it reflects no credit on the people that are doing it, and no credit on the regulators and voters that allow it. So I think we have a lot to be ashamed of in current conditions.
But it's where the money is.
Yeah, but it's shameful what's going on. Yeah. It's not just stupid, it's shameful.
It's not. I don't regard it as shameful on a lot of the people that gamble. I mean, gambling is a very human instinct, and they've got money in their pocket, and they know somebody else that's made money who they don't think's any smarter than they are.
I don't mind the poor fish that gamble. I don't like the professionals that take the suckers.
All right, Moshe Levine writes in. He's an American living in Israel. He says, if you deem stock prices to be overvalued or in a bubble, do you think it's best to keep your money in cash while waiting for prices to come down to a fair price? Or would it be a better idea to invest this money in some way while waiting until stock prices are fair again and then sell the investment to buy the stocks?
Well, Charlie and I have had that discussion on a lot of things. We bought some stocks we really don't know that much about, but I'm not really comfortable doing that.
You're used to shooting fish in a barrel, but that's gotten harder.
We've got probably 10 to 15% of our total assets in cash beyond what I would like to have, just as a way of protecting the owners and the people that are our partners from ever having us ever get in a pickle. You know, we really run Berkshire to make sure that we don't want to lose other people's money who will stick with us for years. We can't help what somebody does that buys it today and sells it tomorrow. But we've got a real gene that pushes us in that direction. But we've got more than we've got probably 70 or 80 billion, something like that maybe, that we'd love to put to work. But that's 10% of our assets roughly, and we probably won't get a chance to do it under these conditions. But conditions change very, very, very rapidly sometimes in markets, and we do have people that would like to join us, but the market option they have is just too great for them. And if they're publicly traded, I mean, they basically can't. They would have great difficulty, then making a deal with us because somebody else would come along with using other people's money. It's, we may be unhappy about the 70 billion, but we're very happy about the other 700 billion. So it's not like we should complain.
Warren, when we spoke before the annual meeting, you said that it was okay if I asked a follow-up or two, and I'd like to take one of those right now. You said you bought some stocks that you don't know a lot about. What are they?
Well, I will not get into naming what stocks, and maybe that there's some there that I think I know about that I don't know about. But we have bought stocks where Charlie and I mean, we know the business generally, but we don't have any insights. And they are, as a group, if I had to, if it told me I was going to be shot unless I got the best result, I would rather own those stocks than the treasury bills we own. But on the other hand, we work with the quantities of money where if we put $50 billion into things that I'm kind of so-so about, but that are better than treasury bills, it doesn't, I'm not wildly comfortable about that, even though it can be undone. It's selling $50 billion when it's really attractive to buy something else. There's a lot of slippage that can happen in moving sums like that around. So that's something we talk about all the time. They're good companies. They're fine companies. But do we know something about those companies or have a way of evaluating that gives us an edge? The answer, I think, what do you feel about it, Charlie? We've talked about it a lot.
Well, of course it's a lot harder. And I think one consequence of this present situation is that Bernie Sanders has basically won. And that's because everything boomed up so high and interest rates so low. What's going to happen is the millennial generation is going to have a hell of a time getting rich compared to our generation. And so the difference between the rich and the poor in the generation that's rising is going to be a lot less. So Bernie has won. He did it by accident, but he won.
All right, this question comes from Denny Poland, a shareholder from Pittsburgh. A prominent senator recently categorized share buybacks as a form of market manipulation. You've often said that repurchasing shares at prices below intrinsic value benefits continuing shareholders. Could you and Charlie please elaborate on the higher order effect that these share repurchases have on society?
Yeah, they're a way essentially of distributing cash to the people that want the cash when other co-owners mostly want you to reinvest, and it's a savings vehicle. If the four of us sitting at this table decided we'd buy a few Dairy Queen franchises, we form a little company, and we all put in $1 million or something like that, and we buy the Dairy Queen franchises, and they're doing well. And three of the four of us want to keep buying more Dairy Queen franchises.